Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Recently, we've been seeing a lot of congestion that has come after incredibly volatile conditions, and this is a significant transition that leads to what we typically see in technicals as being breakout patterns. We've seen a lot of these breakout patterns as of late, and I get constant questions after putting and presenting these breakout opportunities or these range opportunities as to what the trading strategy is. And some of them are outright, where's the target or which direction are we going? So in today's strategy video, I think it's appropriate that we talk about when should we trade breakouts. All right? Because right now, looking across the markets, we have plenty of opportunity in this congestion, this consolidation that will inevitably end in a technical break and subsequently some measure of follow-through. Euro USD, Aussie USD on a shorter time frame, S&P 500, very, very tense. All right, a lot of options. But the first thing that we have to understand about trading breakouts is it's best to trade the breakouts after they happen. The most frequent question I get is after presenting a situation like this where we have a consistent rise into a solid or a horizontal level of resistance is what direction? All right. It is best not to preempt a breakout unless there are two very certain circumstances. One, you are exceptionally confident of the eventual outcome. There are very few of these situations where I think that I am, let's say, 85-90% or plus confident in a trade. Maybe one of the exceptions would have been Euro Swiss back when it made its first break off of that floor. Why? Because the S&P had committed itself to a floor of 120. So a break to the downside would have been very, very unlikely. But this doesn't happen very often. The other exception is when there is a bigger trade in play, and the breakout itself is not necessarily relevant. It could be a good catalyst, let's say like the euro-yen. We were seeing a consistent rising trend as the bigger position. We were just using that short-term break as a catalyst point to ensure continuation. All right. Here, the interest is that with this break, it's not necessarily the makings and the be-all, end-all of the actual trade itself. It's just another aspect that would provide for a better level of confidence. But even if it did break to the downside, if the overriding appeal would still have been to go with the dominant trend and you were trading that bigger trend, let's say this larger trend line, then that would be the ultimate interest. In those circumstances, we can take a trade before the actual break is confirmed. Now, we're talking about the actual ranges and breakout potential that they represent, or the wedges in the breakout opportunity they present. So in general, when we look at a range, like you're seeing here, this is actually a wedge, we know that there's a good probability of a breakout eventually. However, as it stands now, especially if the market is horizontal, or we have a wedge that is essentially in equilibrium, an asymmetrical range or asymmetrical wedge as we call it, that is a reflection of indecision and subsequently speculative and fundamental balance. The reason it does not go for a break is because there is a market that is either confused or confident in the level that it is currently tracing out. So there's not enough conviction to actually get that breakout. If we try to preempt, that balance can be thrown out of skew either way. In other words, it can turn out to be a bullish or a bearish breakout with the proper catalyst. All right. Of course, when we look for catalysts, we have to reference the big ticket items, the big ticket technical or fundamental event risk, like the docket that we have here, upcoming, let's say the pound. If we were looking at a pound-based pair, we'd look for the BOE minutes in the UK unemployment rate. If we were looking for the US dollar-based pair, we would look ahead to the US CPI figure. We would look for these catalysts, but you always have to look for the catalysts that truly have influence over the market. All right. If I were looking at, let's say, the Empire Manufacturing Indicator for the US dollar this past session, while it does have its influence on a fundamental basis and it does tap into some extent into the underlying economic outlook, it is not what carries the current. What really moves the market is interest rate expectations, taper expectations, general risk themes, and an empire indicator or empire manufacturing indicator simply can't tap into that. A CPI figure can because it's one of the dual mandates of the Federal Reserve. So we look for those catalysts. All right, fundamentals are one side, of course. The technical break is another. And if you don't have a technical break and the fundamental conviction behind it, it is likely to be a false breakout or a break that goes absolutely nowhere after the initial move is made. You want to avoid that. All right, those are not good breaks because, as I say far too often, it's not the breakout that makes the trade, it's the follow-through. We don't make money on the 10-pip move beyond a technical level. We make the money on the actual follow-through after that breakout. All right. So we have to look at these catalysts and these general conditions and understand that the market is in imbalance and the break itself is when it tips out of balance. And that's what we're taking advantage of. Now, there is absolutely a bias. All right? When we're looking at the S&P 500, for example, we know that there is a strong bullish bias behind this. So when we have a situation where we have a very consistent bullish run here into horizontal resistance, that the bias is absolutely a bullish one. All right? From a purely technical perspective. A lot of fundamental traders would argue that, and as you should, I argue that from a fundamental perspective as well. However, technically speaking, we can see that bias. Now, that bias may incur a expectation, but we can still get a break to the downside. We can break this rising, this short-term rising trend here, and get a move to the downside as well as breaking 1850 and getting a little bit of follow-through. The bias is valuable in such that it tells us where the market is more likely to find follow-through and consistency. In this very basic graphic, if you can identify this currency pair, I'd be very impressed as I stripped all mention of it out of there. But you can see that generally the trend is lower. The bias is lower for this wedge formation. So a break to the downside is more likely to find natural follow-through. All right. If we were to get a break to the upside and it were lacking for a very genuine fundamental appeal, then it might get that break and then subsequently level off, and we wouldn't get much in the way of return. So that bias may improve the circumstances for follow-through, but it does not necessarily give us much of an advantage when we're looking for the probability of direction for the break. So it is always best to wait for that technical cue and to wait for the fundamental cue that would support it for the follow-through. All right. Now, I want to run through a number of possible breakout opportunities because there are a lot out there, and I want you to think in these terms. Look for that breakout first. Look for the fundamental catalyst to get it moving. And is it the kind of fundamental catalyst that would keep it moving? Be aware of the bias and whether it has or it supports the continuation of the markets. All right. So the first and foremost, I think, that carries a lot of influence beyond its own technical bearings is the S&P 500. You can see here that this is a 9 consecutive day rally. This is the third largest rally or most consistent rally that we've seen from this index since this bull wave began. All right, and this is certainly under bearish momentum, but there is a lot of fundamental concern about the continuation to the upside. A break above 1850 is a better probability given the larger trend. However, not by much, because the follow-through implications of the bias have been severely truncated. A move to the downside could happen much more rapidly given the bigger disproportionate lean that we've had from this particular benchmark. And as you know, this is a great benchmark for risk trends. So if we see some big activity on this particular measure, expect to see heavy volatility from other risk-sensitive assets. From the FX side, the US dollar is looking at the opposite lean. We have a consistent decline that on Monday put in for a green bar. We have a general descending trend channel, and that is coming up against this rising trend line here. So this is in fact a breakout opportunity. You have a descending trend line versus a rising trend line, and that creates a very aggressive breakout potential. And we will see what happens in terms of the break direction as well as the fundamental catalyst that occurs it, because right now conditions are exceptionally quiet, as you can see in this ATR. Now, getting into the currency pairs, the Euro USD chart that I showed you a little bit before, this is a multi-year, in fact 2-year rising wedge formation. All right, you can see that we are in a mini year, over 11 years, or sorry, over 10 years wedge formation here, and we are at the very top of that. So this is 2 very large wedge formations. Remember the concept of the scale of the chart that you're looking at generally sets the time frame for the trade that you take, as well as the potential for technical movement. So if we were looking for a breakout on a multi-year wedge, it might take weeks, if not months. So play it with reasonable expectations. Now, in contrast, we can have something that is a little bit more immediate. Aussie dollar. This is an 8-hour chart. We have a rising trend into this horizontal resistance at about 90.80. You can see a breakout. We're essentially 80 pips wide on the range or on the wedge that we would have here. So a breakout is probably pretty likely over the coming couple of days. Now, something a little bit, or even more immediate, dollar CAD. This is something I've been talking about on the real-time newsfeed. This is an 8-hour chart. This is a very aggressive, very thin descending wedge pattern. All right, you can see that it has less than 40 pips of wiggle room, and a breakout is almost certain over the next 12 hours. Whether it has strong follow-through or not remains to be seen. And what direction it goes, I know a lot of people are trying to preempt this move, but it's best to wait. All right, it's best to wait. It's worth paying a little bit in lost gains to have a greater sense of confidence that it's going to be a positive trade, that the trade will work in your favor. All right, trying to preempt, you can get cut by 1,000 cuts. All right, 1,000 little losses as we pick the wrong direction the market would get in. And of course, it's not necessarily worth those many little losses, because we could just wait and give up, let's say, 25 pips looking for that breakout to confirm. We also have a little bit less usual currency pairs. Kiwi yen, all right, rising wedge here, looking for a breakout, relatively narrow range. We know the larger trend is up, and recently this trend has been up, so it's more of a long-term bull, short-term neutral, and medium-term bull. So the bias is bullish, but we wait for the breakout, because this is also connected to the same thing the S&P 500 is, risk trends. Aussie yen, similar situation. You have a rising trend here into this trend line resistance. All right, a breakout is probably within the next couple of days, maybe through Friday. We can have even pairs like pound Aussie. All right, this one is just general chop. As you can see here, very, very unusual for this currency pair, and this one's a very volatile pair. And we can see the larger bias here. All right, it's tempting to try to preempt these technical breaks, because we see so much potential on the other side of the break. However, how many times have we been caught on the wrong side of a breakout? How many times have we seen a breakout that doesn't have genuine follow-through? And preempting a break on something that doesn't have genuine follow-through, and you get on the wrong side or the right side, it ends up being a losing trend regardless. All right? So it's best to wait for that break, the technical move, the fundamental confirmation, and putting it all together in a general strategy. That is the best way to trade breakouts. All right? Hopefully you find this useful. We'll do our next strategy video tomorrow.